This video instructional will briefly discuss the three-statement financial model, which is the financial model at the basis of all other financial models. The agenda of this instructional is structured as follows. We will start by giving a definition of a financial model and discussing its use cases. We will share an overview with regards to types of financial models that exist, highlighting the financial model of this instructional, the three-statement financial model. Finally, we will explain how to use the three-statement financial model template, so you're all set to go and able to apply it at your current or next client engagement. What to understand from a financial model or the art of financial modeling. Financial modeling is a process of creating a summary of a company's expenses and earnings in the form of a spreadsheet that can be used to calculate the impact of a future event or decision. In fact, a financial model is a tool we create to forecast a company's financial performance based on actuals and assumptions. There are different use cases for financial models, which all come back to the notion that it enhances the ability to make a data-driven decision and a recommendation. A first use case for a financial model are corporate decisions. Financial models support decision-making using historical and expected corporate performance. For example, it allows to evaluate the impact on working capital requirements of making payment conditions more strict for suppliers before implementing the measure. Thus, financial models allow for strategic planning based on data-driven decision-making. A second use case is for making data-driven investment decisions. Financial models allow us to assess the value of specific companies in standalone and collaborative scenarios. Valuation of equities through financial models will allow companies to enhance their portfolio management capabilities. A third use case for financial models is the assessment of opportunity to be found in predefined projects. It allows us to compare and evaluate different investments based on expected profitability, but also based on impact on the company's balance sheets and or cash flow. It enables informed decision-making as to whether or not invest in a project. Finally, financial models are also an important tool to evaluate potential in merging with or acquiring another company. They also allow us to evaluate the impact of raising equity and or debt throughout the company's financials. There are different types of financial models, but they all start from the three-statement financial model. The three-statement financial model is the basis for many other financial models, such as models focused on company valuation, raising of capital, or leveraged buyouts. The three-statement financial model connects a company's balance sheet, income statement, and cash flow statement, and allows for performance assessment both for actuals as forecasts. To use and implement a three-statement financial model for the company you are working for is actually quite simple when using the three-statement financial model template. The first step is to fill in the actuals with regards to the company's balance sheet, income statement, and cash flow statement based on existing financial information from current and or previous years. Using this information, based on the actuals for the balance sheet, income statement, and cash flow statement, the model automatically calculates key parameters. These parameters do not only provide us with important insights with regard to the company's financial profitability, solvency, and liquidity, they also form the basis to forecast a company's future financial performance. As a third step, based on the parameters of the actuals, one has to forecast the value for these parameters based on a chosen method which works for the situations and or data. We can use, for example, moving averages or regression analysis to forecast certain parameters into the future. As a last step, based on the forecasted parameters, the model automatically will produce a forecast for the company's balance sheet, income statement, and cash flow statement. Now we have a complete three-statement financial model, which allows us to evaluate past, current, and future financial performance. Now let's take a look at the Excel template. Financial model template, we notice that there are three different tabs. The first tab, disclaimer, acts as a reminder that given this model is based to a large extent on a model template from the Corporate Finance Institute, one cannot share this model as is with the client before tweaking it to the specific engagement. If we head over to the tab Instructions, we can find the summarized instructions on how to use the three-statement financial model. Remember, we start from the actuals, the existing financial information, and fill in the balance sheet, income statement, and cash flow statement accordingly. The model will then automatically calculate important parameters for the respective years. Based on the parameters of the actuals, we have to forecast the value of these parameters based on the chosen method. Finally, the model will use these forecasted parameters to complete the balance sheet, income statement, and cash flow statement for the respective years. Now, if we head over to the third tab, the three-statement financial model tab, we can find the actual template. In the left column, we see the different aspects of the model, how the model is structured. And then from column B to I, we have the different years. We have the actuals, and then we have the expected years, or the years which have to be forecasted. Now, if we unfold the model, we can see different colored cells. Blue cells are cells that are automatically calculated by the model. The red cells have to be calculated by the user or inputted by the user. So for the actual years, we start by inputting existing financial information for the income statement, balance sheet, cash flow statement. The model will calculate parameters on this existing financial information automatically. We start from these parameters to calculate their forecasted values, and the forecast is right over here, and the model completes the rest. If we scroll down, we notice that the model to a limited extent already provides some insights regarding past, current, and future financial performance. However, the true objective of this template is to forecast how the future balance sheet, income statement, and cash flow statement of the company will look like based on past and current financial information. Hereby, we conclude this video instructional on financial modeling, emphasizing on the three-statement financial model. Thank you for listening.